Tom Lee from Fundstrat Global Advisors just made a bold call saying that retail investors are about to jump back into the market and chase this rally hard, potentially pushing stocks even higher after pulling back during the recent war-driven panic. In this interview on CNBC, Tom Lee breaks down what's changed, why retail stepped away in the first place, and why he believes they're about to come rushing back in. He also talks about the strength of the U.S. consumer and what that means for the broader market going forward. I'm going to show you the clip first, then I'll break it all down and give you my honest take on what he got right and what investors might be underestimating. And after that, I'll walk you through 3 long-term stocks to buy now based on this setup. Let's hear what Tom Lee has to say.
My next guest sees more records ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. Fundstrat's head of research, Tom Lee, is here. He's a CNBC contributor. It's great to have you here, Tom. What do you see going on here?
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit. You know, the software stocks, and as that fell, we know there were record inflows into software, and of course the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff lows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were, you think, kind of going the other way this time.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. You know, they didn't really know how big this war could become. You know, their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing, because there were too many people warning about the tail risks of that.
Is it possible they're right? You know, I was in a store earlier today and the radio was on. I haven't heard the radio in a long time. And the DJ it was some kind of pop or kind of broad station. And he was saying, you know, another check on gasoline prices, and boy, aren't they high? And I thought, wow, that's the first time I've heard gasoline prices talked about in a non-business news context in a while. Is it possible that actually there is going to be a bigger impact here and the retail investors actually know that, and maybe the pros are missing it?
I mean, anything's definitely possible. One thing that we were at Fundstrat were emphasizing is that inflation adjusted, even gasoline prices here aren't nearly the burden they were 5 years ago, 10 years ago, even at the '08 peak. And the war is stimulating the economy, and we can see that in the earnings estimates, in the ISM, and even the jobs report. So I think the state of the consumer is one thing versus maybe how they might hear in a radio commercial or the surveys, but I do think the consumer is in better shape. So I think the retail investor will end up chasing this stock rally.
And you think as they do, that will power it higher?
Yes, but for the right fundamental reasons, because earnings estimates are higher. The U.S.'s relative position has really been strengthened by what's been exposed by supply chains through this war. And I think as the world investor looks for growth and they worry about growth in general, they're going to buy the U.S. stock market, which is a growth index.
We're going to talk in just a moment about international and whether, you know, you should, not that you have to choose, you can do both, but if you had to pick U.S. versus international, is it U.S.?
I'd still be overweighting U.S. because I think if you think about where innovation comes from, whether it's in tech, healthcare, or financial services or fintech, that's really U.S. companies. And I think there was an argument the U.S. PE should derate, but the war has exposed that the U.S. multiple should be going up.
Really? So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in the market's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.
First off, the big picture of what this interview is about is simple. Tom Lee is basically making the case that despite geopolitical tension, despite fear, despite hesitation from investors, the stock market is still positioned to move higher. And in his view, one of the biggest missing pieces that could push it to new highs is retail investors stepping back in. And that's where things start getting interesting, because what he's pointing out right away is something that doesn't line up with what most people would expect. Typically, over the last few years, retail investors have been trained to buy the dip. That's been the dominant behavior pattern. Anytime there's fear, anytime there's uncertainty, retail usually steps in aggressively. But this time, during the buildup of war tensions, that didn't happen. Instead, retail pulled back. And that tells you something important. It tells you that this wasn't just a normal dip. This was a confidence shock. Tom Lee explains that a lot of retail-heavy sectors, especially software stocks and even the so-called mega-cap leaders, were already getting hit going into this situation. So when geopolitical risk entered the picture, it wasn't happening in a vacuum. It stacked on top of existing weakness. So instead of investors saying this is a buying opportunity, they said this might be the start of something worse. And personally, I think that's actually a rational reaction. People like to pretend retail is always emotional and wrong, but in this case, stepping back when uncertainty is layered and not isolated makes sense. If multiple risk factors are hitting at once, caution isn't stupidity, it's risk management. Now here's where Tom Lee flips the narrative. He says that a lot of those worst-case fears, what he calls tail risks, have now been reduced. And what's happening behind the scenes is that hedge funds, the so-called smart money, have already started adding risk again. That's key, because in most market cycles, institutions move first and retail follows later. So if hedge funds are already positioning for upside and retail is still on the sidelines, that creates what I'd call a fuel gap. And that gap can be powerful, because when retail finally comes back in, they don't ease in slowly. They chase, they accelerate momentum, they amplify trends. And that's exactly what Tom Lee is suggesting could happen next. Retail money coming off the sidelines could act as the next wave that pushes markets to new highs. Now the interviewer brings up something really interesting. Why didn't retail just buy the dip like they always do? And Tom Lee admits, even he was surprised. He thought retail would behave the same way they have in the past. But according to their internal surveys, a lot of investors were confused. They didn't understand how big this conflict could get. They were worried about things like oil prices spiking, inflation surging again, and potentially triggering a recession or even worse. And this is where psychology really comes into play. When fear is undefined, people freeze. If you tell investors, this is a short-term dip, they buy. If you tell them, this could spiral into something global, they hesitate. And I think that hesitation is exactly what we saw here. It wasn't just fear, it was uncertainty about the scale of the risk. Then the interviewer pushes back with something that I actually think a lot of people watching were thinking too. What if retail is right? What if they're seeing something the professionals are underestimating? They even bring up something very relatable. Gas prices being talked about again outside of financial media. That's a signal. When everyday conversations shift toward economic stress, that's when things start to matter at a broader level. And this is where Tom Lee takes a more data-driven stance. He basically says, yes, anything is possible, but if you look at inflation-adjusted terms, gas prices today are not as painful as they were in previous cycles. He points to economic data like earnings estimates, manufacturing indicators, and job reports to argue that the consumer is actually still in relatively strong shape. So his view is that perception and reality are not aligned. People feel worse than the data actually suggests, and that's a powerful setup in markets, because when sentiment is weaker than fundamentals, you often get upside surprises. Now here's where I want to add my own take. I agree with him partially. The data can look strong while cracks are forming underneath. We've seen that before. But I also think he's right in the sense that markets don't move based on how people feel. They move based on liquidity, earnings, and positioning. And right now, positioning matters a lot. If too many people are cautious, it creates room for upside. So when Tom Lee says retail will eventually chase this rally, he's not just guessing. He's looking at a setup where the ingredients for that behavior are already in place. Then he takes it a step further. He says this isn't just a momentum-driven rally. He believes there are fundamental reasons for stocks to go higher. He points to rising earnings estimates, the relative strength of the U.S. economy, and how global investors are likely to favor U.S. markets when they're looking for growth. And that leads into one of the most important parts of the interview, the US versus international debate. When asked directly, he says he would still overweight the US, and his reasoning is straightforward: innovation. He argues that whether you're looking at technology, healthcare, finance, or fintech, the US is still the dominant force, and because of that, it deserves a premium valuation. Now this is where things get a bit more bold. He's not just saying earnings will grow, he's also saying valuations could expand. That means stocks could go up not just because companies are making more money, but because investors are willing to pay more for those earnings. And that's a powerful combination. Earnings growth plus multiple expansion is how you get strong bull market phases. But I'll be honest here, this is also where I get a bit cautious. Because multiple expansion depends heavily on confidence. It depends on interest rates, policy clarity, and macro stability, and he even hints at that risk when he mentions the upcoming change in the Federal Reserve leadership. That's not a small factor. Anytime you have a new Fed chair coming in, markets will test them. They will test their stance on inflation, rates, and liquidity, and that can introduce volatility even in an otherwise bullish setup. So while the overall tone of this interview is optimistic, it's not without risks. What Tom Lee is really saying, if you strip it down, is this: the market absorbed fear, institutions stepped in, retail is still hesitant, fundamentals are holding up, and if retail comes back, that could be the final push higher. But the path there might not be smooth. And that's the key takeaway. This is not a blind bull case, it's a conditional one. It depends on behavior, it depends on confidence returning, and it depends on macro risks not escalating again. So the real question isn't just will the market go higher, it's will retail investors believe enough to participate? Because if they do, that's when things can really accelerate, and if they don't, then this rally might stay more contained than people expect. Now, let's dive in and talk about what this means for the 3 specific stocks to buy for the long term and sectors you should be watching next. The first company is Advanced Micro Devices Inc., ticker symbol AMD. Now before we even talk numbers, you need to understand why this business actually matters. AMD is not just a chip company, it is a foundational layer of modern computing. Every major technological shift happening right now, from artificial intelligence to cloud computing to high-performance gaming, relies heavily on advanced semiconductors. And AMD is right in the middle of that ecosystem. For years, AMD was seen as the underdog. It was the company trying to catch up. But that narrative has shifted in a big way. Today, AMD is a serious competitor across multiple high-growth segments, including CPUs, GPUs, and data center chips. And this is where the long-term story really starts to get interesting. One of the biggest drivers for AMD is the explosion in demand for data centers and AI infrastructure. As companies invest billions into building out AI capabilities, they need powerful chips to run those systems. This is not optional spending, this is mission-critical infrastructure, and AMD has positioned itself to capture a meaningful share of that demand. The company has been gaining traction in the data center market, which is one of the most profitable segments in the entire semiconductor industry. This is where margins expand, where long-term contracts exist, and where customers tend to stick around. Now, from a financial perspective, AMD has shown strong revenue growth over the years, supported by its ability to take market share and expand into higher value segments. The company has also improved its profitability profile, which is critical for long-term investors. But what really stands out is the combination of growth and opportunity ahead. According to the broader analysis, AMD is still trading below what many consider its fair value based on long-term earnings potential. That means investors are not fully pricing in how large this opportunity could become, especially in areas like AI and cloud computing, and this is where I want to add my own perspective. AMD is not a low-risk stock. It operates in a highly competitive industry. Innovation cycles are fast and execution matters a lot, but that is exactly why the upside can be so powerful. Because when a company proves it can compete at the highest level in a critical industry and still has room to grow, that is where long-term investors can really win. Another key factor here is diversification across end markets. AMD is not relying on just one revenue stream. It has exposure to consumer PCs, gaming, data centers, and embedded systems. That diversification helps stabilize the business over time and creates multiple avenues for growth. And let's talk about AI specifically, because this is the trend everyone is focused on. The demand for AI chips is not a short-term hype cycle. It is a structural shift in how computing power is used globally. Training models, running inference, scaling applications, all of that requires more advanced hardware. AMD is building products designed specifically for these workloads. And while competition exists, the overall market is expanding so rapidly that multiple winners can emerge. So when you look at AMD, you are not just buying a chip company, you are buying exposure to one of the most important technological revolutions of our time. Now let's connect that back to long-term investing. What you want in a long-term stock is not just growth. You want durability, you want relevance, you want a business that will still matter 10 or 20 years from now, and AMD checks a lot of those boxes. It operates in an industry that is only becoming more important. It is proven it can innovate and compete. And it has clear growth drivers that are still in the early stages. That combination is powerful. But of course, no investment is perfect. One of the risks with AMD is the cyclical nature of the semiconductor industry. Demand can fluctuate based on economic conditions. Inventory cycles can create short-term pressure on revenues. And that is something you have to be comfortable with as an investor. Another factor is competition. This is not an industry where you can relax. Companies are constantly pushing the boundaries of performance and efficiency. That means AMD needs to continue executing at a high level to maintain its position. But again, this is where long-term thinking comes in. If you believe that computing demand will continue to grow, if you believe that AI will reshape industries, and if you believe that AMD can maintain its competitive edge, then short-term volatility becomes less of a concern. It becomes an opportunity, and that is really the mindset you need when looking at a stock like this. You are not trying to time the perfect entry based on short-term price movements. You are trying to identify a business that can grow and compound over time, and AMD has that potential. Another thing I want to highlight is how the market sometimes misprices growth. When there is uncertainty, when there is fear, or when expectations shift, even strong companies can trade below their intrinsic value. That creates opportunities for investors who are willing to look beyond the noise. And based on the current analysis, AMD appears to be one of those opportunities. The market may not fully appreciate the long-term earnings power of this business yet, and that gap between perception and reality is where returns can come from. So if you are building a long-term portfolio, and you want exposure to technology, innovation, and structural growth trends, AMD is a name that deserves serious attention. It is not the safest stock in the world, it is not the most predictable, but it is one of the most relevant. And in investing, relevance over time often leads to returns. Now before we move on to the next stock, I want to hear from you. Do you think AMD can continue gaining ground in the AI and data center space, or do you think competition will limit its growth over the long run? If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's move on to the next company. The second stock in this list shifts away from semiconductors and into something even more powerful in a different way. A business that sits at the center of global capital flows, real assets, and long-duration wealth creation. This company is Blackstone Inc., ticker symbol BX. Now if you only think of investing as buying stocks on a screen, you are missing the bigger picture, because underneath all of that, there is a massive system that controls where money actually goes in the real world. Real estate, private equity, infrastructure, credit markets. That entire ecosystem is where Blackstone operates, and that is why this business matters. Blackstone is not just an investment firm, it is one of the largest alternative asset managers in the world. It takes capital from institutions, pensions, and wealthy investors, and deploys it into long-term investments that are not always accessible to everyday markets. What makes this powerful is not just the scale, but the structure of the business. Unlike traditional firms that rely heavily on transaction fees, Blackstone has built a model around long-term capital management. That means it earns steady management fees over time, and in many cases also participates in performance upside when investments do well. This creates a compounding effect that is very attractive for long-term investors. Now let's zoom out for a second. We are in an environment where institutional capital is looking for yield, stability, and diversification away from public markets. At the same time, private markets are expanding rapidly. More companies are staying private longer. More capital is flowing into real assets, and more investors are looking for exposure to returns that are not tied directly to daily stock market volatility. Blackstone sits directly in the middle of that shift, and that is the long-term thesis. The business benefits from multiple tailwinds at once: growing global wealth, increasing demand for alternative investments, and the continued expansion of private credit and real estate strategies. From a financial standpoint, Blackstone has built an enormous asset base under management, which generates recurring fee income. That means the business has visibility into future earnings that many companies simply do not have. It is one of the reasons investors view it as a compounder rather than a cyclical financial stock. Now, I want to be clear here. This is not a simple business to understand at first glance. It does not behave like a typical tech stock. It does not move purely on earnings beats or product cycles. Instead, it moves with capital flows, interest rate environments, and investor demand for alternative assets. And that is where the opportunity lies. Because most retail investors are not thinking about private markets. They are focused on public equities. But institutions are doing the opposite. They are increasingly allocating more capital into private strategies. And Blackstone is one of the biggest beneficiaries of that shift. Another important angle is inflation and real assets. When inflation is elevated or uncertain, investors tend to look for assets that can preserve value over time. Real estate, infrastructure, and private credit often become more attractive in those environments. Blackstone has exposure to all of these. That gives it a unique position in a portfolio context. It is not just growth exposure. It is also a form of structural diversification. Now let's talk about performance drivers. One of the key factors for Blackstone is capital raising. The more money it raises, the more fee-generating assets it manages. That creates a compounding base of revenue. Over time, that snowball effect becomes very powerful, because even if markets are flat, as long as capital remains under management, fees continue to accumulate. That is why many long-term investors view Blackstone as a way to gain exposure to global capital expansion itself. But there are risks here too. The biggest one is sensitivity to interest rates and liquidity conditions. When capital markets tighten, fundraising can slow down, real estate valuations can be pressured, and deal activity can decline. So this is not a risk-free business. It requires a healthy financial environment to fully thrive. However, what makes Blackstone interesting is its ability to adapt across cycles. It has expanded into different strategies over time, including credit and infrastructure, which helps balance performance when one segment slows down. And that diversification is important, because in long-term investing you are not just looking for growth. You are looking for resilience across different environments. Another thing I find compelling here is how Blackstone benefits from complexity. As global financial systems become more complex, institutional investors increasingly rely on specialized firms to manage capital efficiently. That trend does not reverse easily. It actually tends to strengthen over time. So when you combine scale, diversification, recurring fees, and structural demand for alternative assets, you get a business that is deeply embedded in how global money moves. And that is why BX is on this list. It is not a flashy technology story. It is a capital infrastructure story. And those are often the types of businesses that compound quietly for years before most people fully appreciate their importance. Now, before we move to the final stock, I want to bring in something important. If you are building wealth over the long term, you cannot only think in terms of price movements. You need to think in terms of systems, where money flows, who controls it, and which businesses sit at the center of those flows. Blackstone is one of those businesses, and understanding that changes how you view the entire financial market. Because suddenly, you are not just investing in companies, you are investing in the architecture of capital itself. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the final company in this breakdown, a business that quietly controls one of the most valuable assets in the modern world, attention. This company is Meta Platforms, ticker symbol META. Now before we talk about anything financial, you need to understand what this business actually is in today's world. Meta is not just a social media company anymore. That description is outdated. What it really is a global attention distribution system powered by artificial intelligence and advertising infrastructure. Every day, billions of people interact with its platforms. Not occasionally, not casually, constantly. That level of engagement creates something extremely powerful, a data network that improves itself over time, and that is the foundation of the business. Because in the modern economy, attention is currency. Whoever controls attention controls advertising, and whoever controls advertising controls one of the most profitable revenue streams in the world. Now here is where Meta becomes even more interesting as a long-term investment. The company has been aggressively shifting toward efficiency and profitability over the last few years. It streamlined operations, reduced costs, and doubled down on artificial intelligence to improve both user experience and ad targeting. That combination has significantly strengthened its financial profile. From a revenue perspective, Meta continues to generate massive advertising income, but what matters more is how that revenue is being generated. The company's AI systems are becoming more effective at matching ads with users, improving conversion rates, and increasing the value of each impression. That means advertisers are getting more return for their spending, which keeps them locked into the ecosystem. This is what creates a moat, not just user base size, but the ability to monetize attention more efficiently than competitors. Now let's talk about scale. Meta operates some of the most widely used platforms in the world, including Facebook, Instagram, and WhatsApp. These are not niche products, they are embedded into daily communication, entertainment, and commerce for billions of users. That scale is extremely difficult to replicate. Even if a competitor builds a similar app, they do not automatically get the network effects that Meta already has. Because the value is not just the product itself, but the people already using it. And that is one of the strongest advantages in tech investing. Now from a financial standpoint, Meta has shown strong profitability and consistent cash flow generation. After a period of heavy investment in future technologies, the company has shifted back toward efficiency, which has improved margins significantly. But what really stands out for long-term investors is optionality. Meta is not just relying on advertising forever, it is investing heavily in artificial intelligence, virtual reality, and long-term computing platforms. Some of these bets may take years to fully materialize. But when they do, they could open entirely new revenue streams. And that is what makes this stock interesting. You are not just buying a mature advertising business, you are buying a platform that still has multiple paths for expansion. Now I want to add my perspective here. Meta is one of those companies that people often underestimate because it feels familiar. Everyone uses it, everyone knows it, and because of that, people assume the growth story is over. But the reality is more nuanced. Yes, the business is mature in some areas, but the monetization potential of its platforms is still evolving, and the integration of AI into its advertising systems could represent a second phase of growth that many investors are not fully pricing in. At the same time, there are risks. Regulation is always a factor in a company this large. Changes in privacy laws, advertising restrictions, or platform governance can impact growth, and competition in digital attention is always intense. But despite that, Meta has consistently adapted. It has shown an ability to evolve its products, adjust its strategy, and maintain relevance even as the digital landscape changes. And that adaptability is one of the most underrated qualities in long-term investing. Because markets do not reward companies for what they are today alone. They reward companies for what they can become over time. Now if we step back and look at all three companies in this video, a pattern starts to emerge. You have AMD representing the infrastructure of computing and AI. You have Blackstone representing the flow of global capital and real assets. And you have Meta representing the control and monetization of digital attention. Three different businesses, three different sectors, but all connected to massive long-term structural trends. That is what makes this type of investing powerful. You are not chasing short-term headlines. You are positioning yourself around systems that evolve slowly but compound over time. And that is really the core message here. Long-term wealth is not built by reacting to every market move. It is built by identifying businesses that sit at the center of major economic shifts and having the patience to let those shifts play out. Now I want to hear from you. Which of these three companies do you think has the strongest long-term advantage? AMD, Blackstone, or Meta, and why? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.